Hey folks, Dan Frio here with your real estate update for October 11th, 2023. So yesterday I called it. I said mortgage rates should drop about 1/8%, and on the 30-year fixed rate, we dropped 1/8%. How did I know this? Well, I'm not Nostradamus. I just read the tea leaves. No, I actually look at economic data. So that's what we're going to do in today's video. And the first thing we want to look at is in the inflation numbers. So we all know the Federal Reserve is sitting there monitoring inflation tick by tick by tick to see if they're going to increase rates anymore. So what we had come in today is the producer price index. That is how much producers' inflation is going up. Okay, this number came in a little bit higher than analysts expected, but I expected this number to be basically where it is right now. So let's take a deep dive into the inflationary numbers so you get an idea how this might affect real estate, especially mortgage rates. So the last reading we had on the producer price index was everything was up 0.7%. Okay, analysts were saying it's going to come down to 0.3%. My concern was energy. We saw oil spiking to the highest levels we've seen in a long, long time. So I'm like, okay, this number should be probably a little bit hotter than economists expect. So the 0.5 is basically something I would agree with. Okay, so what's been happening over the past month that would cause the inflation numbers to go up more than economists are expecting? Well, if you really take a deep dive into oil prices, here's where oil prices are. Okay, so let's focus in on this. Where were we basically at the middle of the year? Well, about $67 a barrel. Okay, normal oil prices are about $60 to $70 a barrel. Then we saw that number spike all the way up to $94 a barrel, almost peaking $100 a barrel. That's when we started getting really concerned about this. So now oil prices in the last 30 days have gone from 94 to 84. How much of a drop is that? Well, let's go over to our trusty GPT, ChatGPT, and figure that out. Well, if our prices went from 94 to 84, there's almost 11% drop in oil prices. That's going to have a dramatic effect when it comes to our inflationary numbers. So my concern, though, is with the war or the attack on Israel from Hamas, is that going to cause more uncertainties in the oil market? On Monday, we saw a spike in oil, but it's starting to retreat from there. Okay, so that's one piece of this puzzle. The next thing we want to look at is right through here, the headlines that we have from CNBC. 10-year Treasury yields continue falling despite the hot inflationary numbers. Well, if you really took a deep dive into these inflationary numbers that they're referencing, yes, they're a little bit hotter than it was expected, but they're 0.2% lower than where we were. So a nice trajectory downwards right through there. How's the stock market liking this stuff? Well, they're taking it with stride. The Dow Jones is up 100 points. S&P's up 16 points. We have the NASDAQ also up almost 100 points. Now look at what oil's doing. It's starting to retreat back. Okay, this took a spike over the weekend with the invasion of Israel, but now it's starting to settle down. So based on this information we have today, what's happening with mortgage bonds? That's what we really want to focus in on. So we go to the MBS market, and you're going to see right through here. Again, you're going to have to squint because I love when this number is green. The reason why I love this number when it's green is exactly this. We monitor the MBS market. The MBS market is basically a mortgage-backed security. It's a mortgage bond that trades on Wall Street. Okay, this is what you're seeing as the price. But as the price goes up, the yields or your rate comes down. Let me explain this to you. And I try to do this every couple weeks just to inform you guys how actually this works. Okay, if the price goes up, how does the yield go down? So I try to make it as easy as I can. So let's say, for example, we have a mortgage bond. That mortgage bond is going to mature next year. Okay, now we're trying to see what price we're going to pay for this. So let's say, for example, I pay you $50. Okay, I give you $50 for that $100 bond that's going to mature next year. All right, so I give you $50, you give me the bond. Next year, I give you the bond back, and you give me my $100 back. That was the deal. What was my yield on that? Well, it was 100%. I gave you $50, you gave me $100 back. Okay, so that's a high rate. Okay, so now let's say prices skyrocket. Let's say for simplistic reasons that the mortgage-backed security bond I get from you, I pay you $100, a high price. I give you $100. You then, next year, I give you my coupon back. You give me my $100 back. And you're like, Dan, you gave me $100. I gave you $100 back. You didn't have any returns. Exactly. The return on that is zero. So do you see how when the prices go up, the yields come down. So that's what's going into the markets right now. So the one thing I want to explain to you guys too is I know I'm all over the map on this one. I created a website a couple years ago, and people every day I get calls from people. They're like, Dan, here's my credit score. Are you going to do a hard pull? Are you going to do this? Let me give you some tools that you guys can use when it comes to getting your credit. Okay. So a lot of people were fearing that they don't want me to pull their credit because it's a hard hit on their credit, and they're thinking their credit scores are going to plummet. Well, on average, you're going to see about a 3 to 5% point drop when we pull your credit. Okay, not dramatic, but I got an idea for you if you want to pull your own credit and get the exact scores that we would get as the lender. So go to creditscoresandmore.com, and you're going to scroll down through here. There's some free systems in here and so forth. So if you don't have a free system to monitor your credit, I would highly suggest you using this one right here. But if you want to really find out your credit scores, the credit scores your lenders use, you're going to click here, your true credit scores. It's going to pull up your FICO score. Okay, it's a paid service, but the nice thing behind it, it's a soft pull. It doesn't affect your credit scores at all. What I ask people to do is go there, do that, send me a screenshot so we know exactly what your credit scores are. So if you want to use that tool, go to creditscoresandmore.com, and it's available to you right there. The next thing is, if you want to reach out to me, you're like, hey, Dan, I know rates are where they are, but I'd really like to get into a house. I don't know if I make enough money to do that. I don't know if my credit scores are good enough to do that. And I don't know if I have enough money to do that. Well, don't disqualify yourself. What I'd ask you to do is just reach out to us. We would love to help you and manage this this roadmap of home ownership. What you need to do is just right up through there's an apply now button. What you're going to do is you're going to click that. It's going to ask you a series of just a few questions. And those questions are basically to vet you to figure out what analyst or what mortgage specialist on my team we need to assign you to. Are you looking for a FHA loan? Well, you're going to be assigned to that person. You're looking for a conventional loan. You're looking for a jumbo loan. You're looking to buy a multi-unit. Those are the questions we need you to answer so we can assign you to the right person on our team. So if you're like, hey, Dan, can I just call or maybe email you? Absolutely, you can. Just go down to the bottom of our screen, and you're going to find both of those right there. You can give us a call at 844-775-5626, or you can email me directly. And yes, this is me directly, and I will be the one replying. My email is dan@therateupdate.com. Thank you so much for watching, guys. If you find value in my channel, don't forget to subscribe and also give my video a thumbs up. Take care. See you tomorrow. Bye-bye.